Welcome to House Lux Estate, your reliable guide to the world of finance. We've dedicated this channel to unlocking the secrets of financial success, delivering key insights and understanding that you can use to navigate the often complex world of finance. At House Lux Estate, we believe in empowering you with knowledge, and our wide-ranging content reflects this belief. From the intricacies of real estate investments to the dynamics of stock market strategies, we cover it all. Our mission is simple: to provide you with the tools and knowledge you need to make informed financial decisions. We're not just about sharing information, we're about sparking conversations, inspiring curiosity, and fueling your financial journey. So, whether you're a seasoned investor or just starting out, House Lux Estate is here to guide you every step of the way. Today, we delve into the intriguing world of options trading. Diving right in, options trading is a type of derivative trading. Now, I know that might sound a bit intimidating, but bear with me. It's not as complex as it sounds once you break it down. At its core, options trading is quite simple. It involves buying or selling rights. Now, these aren't just any rights. These are rights to purchase or sell stocks at a specified price within a certain period. These rights are not obligations, which means you have the choice to exercise them or not. The beauty of options trading is that it allows investors to hedge against potential losses. Think of it as an insurance policy for your portfolio. If the market takes a turn for the worse, your options can help cushion the blow. But that's not all. Options trading also allows investors to speculate on market movements. If you believe that the price of a certain stock will rise, you can buy a call option. If you think it's going to fall, you can buy a put option. And if your predictions are correct, you stand to make a profit. And let's not forget about income generation. By selling options, you can earn premium income, which can be a nice supplement to any other income you might have from your investments. Now, I know what you're thinking. This all sounds great, but it also sounds complicated. And you're not wrong. Options trading can be complex. There are a lot of variables to consider, and it's not something you should jump into without a solid understanding of the basics. But don't worry, that's what we're here for. Over the next few minutes, we're going to take a closer look at the two main types of options, calls and puts. By understanding these basics, you'll be well on your way to demystifying options trading. Options trading can be complex, but understanding its basics, such as calls and puts, can demystify it. First off, we have call options. Now, call options might sound complicated, but they're quite straightforward once you get the hang of it. At its core, a call option is a financial contract between two parties, the buyer and the seller. This contract gives the buyer the right, but not the obligation, to purchase a specific amount of shares of a stock at a predetermined price, known as the strike price, within a set period of time. Imagine you're at an auction, and you have your eye on a particular piece. You're not sure whether the price will skyrocket, but you want the option to purchase it at today's price. That's essentially what a call option allows you to do, but with stocks instead of auction items. Now, you might be wondering, why would anyone want to buy a call option? The answer lies in speculation and risk management. Investors typically buy call options when they anticipate that the price of a stock will increase in the future. If their prediction is accurate, they can buy the stock at the lower strike price and then sell it at the current market price, pocketing the difference. But remember, call options come with a time limit. If the stock price doesn't rise above the strike price before the expiration date, the option becomes worthless. So there's a bit of a race against time involved. There's also a cost to engage in this kind of transaction. This cost, known as the premium, is paid to the seller of the call option. Think of it as a fee for the opportunity to potentially profit from a stock's price increase. So, to sum it up, call options give you the right to purchase a stock at a set price within a certain time frame. They're typically used when investors are feeling bullish about a stock's future performance. Optimism about a stock's future performance is the driving force behind purchasing call options. On the flip side, there are put options. Now, this is where things get intriguing. Put options, as the name suggests, are quite the opposite of call options. They provide the buyer with the right, but not the obligation, to sell a particular stock at a specified price, known as the strike price, before a certain date, referred to as the expiration date. Picture it this way. You're holding onto a stock that you suspect might decrease in value over time. Now, you wouldn't want to be left clutching a depreciating asset, would you? That's where put options come into play. By purchasing a put option, you secure the right to sell that stock at the strike price, regardless of how far the market price might plummet. It's like having an insurance policy for your stock, providing you with a safety net in case of a market downturn. But why would anyone buy a put option? Well, investors typically purchase put options when they predict a decrease in the stock's price. This could be due to various reasons, such as negative market trends, poor company performance, or economic instability. Essentially, they're betting that the stock's price will drop before the expiration date. It's important to note that the buyer pays a price for this right, known as the option premium. This premium is influenced by several factors, including the stock's current price, the strike price, the time until expiration, and the stock's volatility. However, like all investments, put options come with their own set of risks and rewards. If the stock's price doesn't decrease, as predicted, the buyer could potentially lose the entire premium paid for the option. On the other hand, if the stock's price does indeed drop, the buyer could sell the stock at the higher strike price, thereby making a profit. So, in a nutshell, put options offer investors a way to potentially profit from a decrease in a stock's price, while limiting their potential loss to the premium paid for the option. Buying put options is essentially betting that a stock's price will drop. Let's recap what we've learned today. In our journey to understand the fascinating world of options trading, we've navigated through some key concepts and strategies. At the core, options trading is a form of derivative trading. It's a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price within a certain period. It's a powerful tool that offers flexibility and leverage, allowing traders to manage risk and potentially achieve substantial returns. We've also delved into the heart of call options. A call option is a contract that gives you the right to buy an underlying asset at a predetermined price before the contract expires. It's like reserving a seat at a concert. You're betting that the price of the asset will rise, and if it does, your call option allows you to buy it at a lower price. On the flip side, we've explored the concept of put options. A put option is a contract that gives you the right to sell an underlying asset at a predetermined price before the contract's expiration. It's like an insurance policy on your car. You're betting on the price of the asset to fall, and if it does, your put option allows you to sell it at a higher price. Investors might buy call options when they expect the price of an underlying asset to rise, while put options are purchased when a price decline is anticipated. It's all about speculation and hedging, about making educated guesses and protecting your investments from market volatility. Remember, options trading isn't for the faint of heart. It requires a good understanding of the market, a well-thought-out strategy, and a willingness to take on risk. But with these tools in your financial arsenal, you can position yourself to potentially reap significant rewards. With this knowledge, you are one step closer to navigating the world of options trading with confidence. We've covered a lot today, but remember, this is just the tip of the options trading iceberg. The world of finance and investment is vast, complex, and continually evolving. As we dip our toes into the fascinating waters of options trading, it becomes clear that the journey of learning never truly ends. It's a thrilling ride filled with potential for growth, discovery, and of course, profit. There's so much more to explore, from the intricacies of calls and puts to the strategies that can help you maximize your returns. And that's where House Lux Estate comes in. Our channel is brimming with informative content on a wide range of financial topics. We're here to guide you as you navigate the complex landscape of finance and investment. So, keep that curiosity alive, keep pushing your boundaries, and most importantly, keep learning. Don't forget to subscribe to House Lux Estate for more insights into the finance world. Until next time, keep investing, keep learning.